Welcome. Our team was hired by Delivery Hero and was asked to recommend an acquisition. We recommend Deliveroo, which we will discuss in this presentation. Looking at the strategic aspect of the acquisition, Delivery Hero could tap into the UK and Ireland market, further increasing its overall market share and penetration of food delivery industry through Deliveroo. It operates in 11 countries, from which 4 is shared with Delivery Hero. In the UK and Ireland, it has roughly 26% market share that equates to roughly 57% of gross turnover volume of Deliveroo. It has 7 million monthly annual users, from which majority is from the UK and Ireland. And also it has a strong brand image and a substantial amount of partners. We believe that Deliveroo might be inclined to this acquisition if Delivery Hero keeps C-suite intact and gives them authority, which facilitates a non-hostile takeover, which they have done in the past. Both firms could benefit from revenue and cost synergy opportunities, which we'll touch upon later on in this presentation. And now I will pass on to Mariam, who will talk about the trading multiples.
The comparators for this analysis were based on location, enterprise value, market value, and availability of data. Since the earnings for most comparators were negative, price to earning and EV/EBITDA ratios were not used. Price to sales and price to sales growth ratio were being the closest alternatives, and most used ratios by this industry were used. All the figures used were of 2022, as 2023 predictions for most companies are very high due to high growth rate during and expectedly post-COVID. The implied price ranges from 102 to 208 pounds, which shows that Deliveroo is currently undervalued. Some reasons for this undervaluation include London's high inflation rate and ongoing recessionary environment, which has reduced real income. Acquisition by Delivery Hero can help reduce cost through synergies, which can allow more customers to use the service. Reduced interest rate and inflation rate in the future will help gain more sales and make this undervalued acquisition profitable. The main key takeaway, however, from this slide is the industry price to sales ratio of 1.47. Price to sales growth ratio hasn't been given a lot of consideration because the growth rate in the past 3 years has been very high and is fluctuating a lot due to COVID, so it's not the best representative of the next few years. I'll now hand over to Benny.
We have looked at 4 previous acquisitions within the food delivery industry to find and justify our transaction multiples. Out of the 4, we've used the 2 most recent transactions to help identify Deliveroo's deal enterprise value and share price, since the transaction multiples have fallen drastically in the last couple of years, and we want to value Deliveroo according to the current market prices, obviously. To sum up, we use the mean of the deal price to sales ratio of the acquisitions of Gorillas and Grubhub, resulting in a PS ratio of 1.9. So this finding indicates that Deliveroo's current share price is heavily undervalued, suggesting that Delivery Hero can get a really good price for Deliveroo. I'm handing over to Katif.
Our DCF suggests a valuation of 156 to 80 pounds per share. We use an exit multiple method. We value Deliveroo standalone, and then we add synergies to that valuation. And then we find an equity value per share of 280. Then we do a sensitivity analysis and derive a valuation range of 156 to 280 pounds per share. We find from all the valuation that the most represented multiple and the most important multiple is a 1.47p to S multiple. This is because this encapsulates the market sentiment most accurately, and it represents what the market feels about Deliveroo in this case. This values Deliveroo at 150 pounds per share. And we recommend acquiring a 70 to 84% stake with a mix of cash and stock. This values Deliveroo at 2.9 billion, and the purchase price would be 2.4 billion. 11% of the company is owned by management employees, which are insiders, and we recommend retaining their stake to incentivize management to buy this company. We recommend that 1.2 billion, 50% of the transaction is used through cash, and 50%, 1.2 billion, is funded by selling Delivery Hero stock to Deliveroo's shareholders. We do not recommend using debt because Deliveroo is at a B- credit rating already, and raising more debt would further deteriorate the credit rating and put financial distress. Equity is not a great option either because the markets are undervaluing companies in this industry, and Deliveroo might not be able to raise cash at a great valuation. Furthermore, acquiring Deliveroo at a $150 per share is a 34% premium over the 7-day average moving price, which is a strong premium given the market history. And this acquisition would lead to a 57% expected return at the end of 2024 using Deliveroo and Delivery Hero's combined revenue.